Okay, so I welcome you, and let's hear the first paper. This is Kyle Wilson from the University of Arizona, who will be speaking about public competition and private investment, and does one crowd out the other, and so on. Here we are, Kyle.
So thank you for having me here today. It's a pleasure to be here, and thank you to the Net Institute for generous funding for this project, helping make this possible. Some research on what I think is a very important topic. And so today I'll be talking about municipal provision of internet access and thinking about the effect that that has on private investment. So quite generally, we can think that publicly provided goods might crowd out similar privately provided goods. There might only be room in the market for one or the other. But at the same time, just having the threat of public provision might induce private firms to act preemptively. Right? They might think that the municipality is going to enter at some time in the future and see fit to act preemptively and make an investment today earlier than they otherwise would have. And so in this paper, I'm going to consider the impact of municipal provision of internet access. And in particular, I'll be asking and answering a few different questions. So first of all, I'll be asking, what is the effect of municipal provision on private investment? Does it increase or decrease private investment as a result? Secondly, I'll be asking, what is it that municipalities value? What is it that's driving them to make these investments and enter markets at times when private firms seem unwilling to do so? And lastly, as a result of these effects, I'll be able to answer and perform some welfare calculations to see what it is that municipal provision adds. So, some existing evidence on the issue, this question of what is it that municipalities value. I have a quote here from a municipal network operator in Kentucky who says, "Unlike the private sector, whose goal is to bring some return to their stockholders, our return is what we can bring to our communities." Okay, so he's emphasizing this point that maybe they're not just profit maximizing agents, but instead are trying to maximize some combination of profits and consumer welfare. There's some economic literature on the matter as well from Timmons and Lim and Yurokoglu. On this second question of how does public competition affect private investment, I have here a quote from an electric provider, not an internet provider, in Iowa, who says, "And right after that, there were two other providers in town, the telephone and internet and cable TV, and once we were approved, they upgraded all their lines and equipment in town." Okay, so this is a municipal electric utility that never actually put in an internet network, but threatened to do so, incredibly, such that the cable and DSL provider in town actually went ahead and upgraded their lines preemptively. And so we also have some economic literature on the issue from Robert Siemens. So why should we care about municipal provision of internet? So this is a practice that's on the rise lately. As of 2014, there were 150 communities in the United States providing municipal broadband to their constituents, and typically using high-speed fiber optic cable. So they're really pushing the envelope on the next generation technology. But at the same time, we have 20 states that have passed bans or some heavy-handed restrictions on municipalities' ability to do this. So these are state-level legislation that are telling cities that they cannot form and operate this municipal network. And so this state-level legislation has been challenged by the FCC, in particular in the states of Tennessee and North Carolina. And the relevant passage from the 1996 Telecommunications Act here says, "No state or local statute or regulation or other state or local legal requirement may prohibit or have the effect of prohibiting the ability of any entity to provide any interstate or intrastate telecommunications service." Okay, and so at least to the layperson, it does sound as though these state-level laws are violating this passage. However, the current status quo is that the U.S. courts have ruled that the FCC cannot enforce this. So as things stand, we do have these 20 states that have bans or restrictions in place. On the economic side of things, why should we care? Well, we might think that private providers can underinvest in new technology relative to what would be socially optimal. Okay, so after making an investment in a new technology, there's going to be some level of surplus created. And a private firm is only going to be able to capture a portion of that surplus. They're going to be able to capture the producer surplus, the profits component of that, but there's going to be some level of consumer surplus left over that the firm cannot capture. And so that limits their incentive to make this investment. So why might we think that a municipality would do better in this regard? Well, if a municipality actually values directly and internalizes that gain in consumer surplus, then they might actually be willing to make the socially optimal level of investment if they're valuing all or at least more of the total gain in surplus that results from making this investment. So let me just kind of walk through what it is that I do in this paper. So the first thing that I do is I estimate a model of demand for internet technologies. So this is demand for cable, DSL, and fiber. To do that, I'm going to use data on households' technology choices, internet service providers' plan characteristics, namely price and speed, and then demographic characteristics of markets. Now, once I estimate this model and have the parameters related to these characteristics, I'll be able to construct measures of market shares as a function of the providers that are present in a local market and the demographic characteristics of that market. With those market shares in hand, I can then construct measures of profitability in those markets and consumer surplus in those markets to get a sense of what it is that's being valued, profits versus consumer surplus. Okay, so with these estimates in hand, I'm going to feed them into a dynamic model of entry and technology adoption. And so this is going to be a model where we have private firms and municipalities potentially competing to serve a market. And they make decisions about entry and whether to upgrade their technology from cable or DSL to providing fiber. And using this model, I'm going to impose that private firms, as we would expect, value just profits. But at the same time, municipalities are going to value profits plus some weight placed on consumer surplus. Right? And that weight is unknown a priori. It's something that I'm going to estimate. The data should be able to tell us to what extent do municipalities actually value consumers as opposed to behaving like a firm and simply maximizing profits. In addition, I'll use, and yeah, so I said I'll estimate that weight. And then in addition to that, I'm going to estimate the sunk costs associated with these actions of entry, technology adoption, upgrading to fiber, and exit costs. And then lastly, I'm going to perform a counterfactual where I take the results from this model and I impose a ban on municipal provision across states that currently don't have such a ban. And I'll be able to observe the simulated actions of firms under such a ban when they no longer face the competition from public firms and they no longer face the motive to preempt them because public firms, municipalities will be unable to enter the marketplace. And then lastly, using the results of that simulation, I'll be able to calculate the welfare loss both to consumers and to municipalities of this ban on municipal provision. So the data that I'll be using for this work primarily comes from the National Broadband Map. This is a really great data set that catalogs the location of every internet service provider in the United States down to the census block level. And so we know where they are. I have this as a panel from 2010 through 2014. So I get to observe changes in the speeds that they're providing, in the technologies that they're using, in new markets that they enter. So this is the primary set of data. On the demand side of things, I'll be measuring the number of subscribers to a given technology by market using the 2014 CPS. In this survey, they ask consumers, they ask households what technology of internet they currently subscribe to. So this gives me the quantity, the market share side of the data. And a notable limitation of this data is that households can only be identified in this data down to the MSA level, which is a fairly broad market definition. And I'll talk in just a minute about how I deal with that. And then lastly, I use plan characteristic data on prices and speeds, which I scraped from inmyarea.com. This is a search engine where you go to this website, you type in your zip code, and it returns to you all of the providers and plans that are available in your area. And so I collected all of this data. And then I used some demographics from the 2014 ACS. So just some of the most salient features of the data that we can pull out of this national broadband map, if we just look at the speed differences by technology, this is fiber to the home technology. Fiber is far and away the fastest of these speeds, right? A full third of fiber installations are capable of providing speeds of at least 1 gigabit per second. That share for cable firms is almost non-existent, and for DSL it's completely non-existent. And then when we look at technologies capable of providing at least 100 megabits per second, a full 82% of fiber is capable, 60% of cable, and again, just a negligible share of DSL. So there are some huge differences in the speeds that can be provided by these three technologies. The second really important feature of this data for the purpose of this paper is to note the differences in technologies installed by these two different ownership structures. Public firms overwhelmingly install fiber optic networks. 76% of the installations done by municipals are done using fiber optic. When we look at private firms, it's less than 20%. Okay, so this is at least suggestive evidence that there's something different about these two parties, right? There's something different about what's motivating public firms or what it costs them to install these technologies. So as I said, the first thing I do is I estimate this demand for broadband. And this is an area where it's not the focus of this paper, but I think there's a contribution here simply because there's a somewhat limited literature on the matter. There's a number of papers I've listed here which do estimate demand, and so I'm adding into that literature. But what I do is I estimate a static multinomial logit model of demand for internet technologies. So we have households that can choose between subscribing to cable, DSL, fiber, or none of the above. And they take into account their utility as a function of the technology, the characteristics of that technology, the price of that technology, the download speed offered in their area, as well as their own characteristics, their income and their household size. So preference for these technologies is going to be able to vary with the characteristics of a household. Now, as I mentioned before, kind of the limitation of this data set is that I only observe subscribership at the MSA level. And the problem with that is that product availability tends to vary quite a bit within these markets, right? In particular, fiber is generally only available to a small subset of any given city. And so, to assume full availability to all of the consumers would lead me to biased estimates in my results, because I'm assuming that people are opting out of choosing fiber when in reality it's simply not available to them. So to get a sense of what this looks like, so here's a map of Tucson where I live, and I'm going to divide every MSA up into sub-markets. So when we look at Tucson, there are 3 sub-markets. The vast majority of Tucson is this kind of medium green, and they have access to cable and DSL technology, but not fiber. Then we have these small pockets of Tucson down here that only has access to DSL, and a couple limited pockets that have access to cable, DSL, and fiber. Okay, so what I'm going to do is I'm going to model demand separately and come up with probabilities that households adopt each of these technologies separately for each submarket. Okay? I can do this using the characteristics of those submarkets, but I don't observe subscribership at that level. I observe subscribership for Tucson as a whole. So then what I do is I take a weighted average of the market shares for these 3 submarkets, weighting by the population in each of these markets. So in Tucson, overwhelmingly, the market share is going to come from the predicted market share for this medium green submarket. Okay? And so I'm simply taking a weighted average across the submarkets K to get a probability at the market level M, weighting by the populations in each market, which is observable in the data. Okay? So now let me sketch out the supply model that I'm going to estimate, where I have these private firms and public firms competing to serve a marketplace. And so the key elements of the model are that these two players, these types of players, are going to enter and adopt fiber. And this is going to be modeled as a dynamic game where the agents are forward-looking. This is going to be really essential because I want to capture this element whereby private firms can think about the likelihood of future municipal entry and then respond to that in the present. Okay? And so in this model, as I said, private firms are going to value profits, and public firms are going to value profits and some fraction of consumer surplus that's generated by fiber becoming available. And that weight, that fraction, is something I'm going to estimate. So just a sketch of what the model looks like. So every market is going to have exactly 3 players. There's going to be a cable firm, a DSL firm, and a public firm or a municipality. So it's not the case that all 3 necessarily serve any given market. They're potential players for the market. And at every point in time, each of these players' status is going to be either a potential entrant, meaning they're not currently serving, they're providing cable or DSL service there, or they're providing fiber service. Okay? Cable and DSL are going to provide either their own technology or fiber if they choose. And a public firm is either going to provide cable service or fiber service. And overwhelmingly, as we've seen, they choose to provide fiber service. Okay? The state of the market is going to include the status of each type. So the feature of the market that's most observable to the players is going to be exactly what the other guys are doing, whether they're providing cable or DSL, whether they're providing fiber. And so then the state space is going to be the full range of possible market structures that can be generated. Now, in each period, each player is going to choose an action. And the actions available to the players are going to depend on their current status. So if you're a potential entrant, you can stay out of the market. You retain the option value to potentially enter later. Or you enter as a cable or DSL provider, as your technology would dictate. Or you enter as a fiber provider. If you're currently a cable or DSL incumbent, you can exit. You can remain a cable or DSL provider, or you can upgrade to fiber. And if you're a fiber provider, you can exit or remain a fiber provider. And then there's going to be, of course, costs associated with taking these actions. So if you're a cable or DSL firm, if you're a private firm, it costs you kappa CD to enter with cable or DSL. If you're a municipality and you want to use this technology, you pay kappa CD plus rho CD. Okay, rho is not restricted to being positive. It's just simply allowing for the 2 parties to have different costs. Same for entering with fiber. If you're private, you pay kappa F. If you're public, you pay kappa F plus rho F. And if you exit, you pay a cost mu X. Okay, and these are known parameters to the players in the model. And then lastly, each firm is going to receive a private information shock to the cost of each of its actions, which helps determine the most profitable action for it to take. So as I said, utility for the agents are simply profits if you're a cable or DSL firm, and they're profits plus lambda times consumer surplus if you're a public firm. And that lambda is that key parameter that I'm going to be estimating. In the interest of time, let me just skip over some of the specifics about how I create these measures. But in essence, they come from the demand side estimates. They allow me to construct measures of profits and consumer surplus. Okay, so these are the estimated parameters of the demand model. A nice way to kind of capture the most important features of it are to look at elasticities. So the response in the probability of choosing one of these technologies with a change in each of these prices or each of these characteristics. So what we can see is that consumers are relatively inelastic with respect to price and download speed. Their elasticities are less than 1. So they're not that responsive to changes in price or download speed. The price one, not too surprising, since internet is a pretty necessary good nowadays. I think the most striking thing here is just how responsive people are to choosing fiber to their level of income. Notice this is far and away the biggest coefficient here, suggesting that as your income goes up, you very quickly become more likely to consume fiber. Here's just a map of the most preferred technology for different levels of household size and income. What we can see is that for a family of 4 with a level of income about $50,000, they're sort of indifferent between all 3 technologies at the average prices for each of these technologies. But as you become a bigger household or a more wealthy household, you strictly prefer fiber to the other 2. Okay, so now let me just summarize the estimates, the results from the model. So what I find is that the cost of installing cable or DSL for a private firm for a market is about $2.4 million. The cost of installing fiber is about $5.8 million. And just to put these numbers in perspective, these are for installing these technologies for a full zip code. And I can compare them to some industry estimates provided by the network engineer from Charter Cable, who provides some estimates of his own. And what he says is that it costs, for a median market in my sample, it costs about $1.8 million to install cable and about $4 million to install fiber. So the results I'm getting are very well in line with industry estimates. And it's not surprising that my estimates are a bit higher, since these are estimated off of the actual decisions made by the firms, which account for not only explicit costs, but the implicit costs associated with the alternative uses of this money as well. Okay? In addition, what I find is that public firms pay substantially more than private firms do. And I think it's important to characterize what exactly these parameters mean. And so, what goes into this fact that it seems as though it's more costly for a municipality to provide these things than a private firm, I think there's a few areas that this stems from. So first of all, municipalities are somewhat learning as they go. They don't have the prior experience that private firms have. Secondly, they don't have economies of scale. They're only providing service to one market. And lastly, there are significant political costs for a public firm. They have to overcome public opposition and regulations to them installing these networks. And so these are largely to be thought of as implicit costs reflecting that fact. And then finally, what I find is that the weight that municipalities place on consumer surplus is about 0.23. So this suggests that they're not simply maximizing profits. This isn't a weight of 0, but it's also quite far from a weight of 1. They're not sort of maximizing the total welfare that's generated as a social planner would. Lastly, I said I would simulate the actions under a counterfactual ban. And if we just look at the bottom line numbers here, there's a lot of stuff going on in there. But the bottom line is that when we ban the practice across the 30 states that currently allow municipal provision, we lose 2.91% of markets that would have had access to fiber through municipal networks. And what effect does that have on private provision? We see it actually increases the likelihood of cable and DSL providers to provide fiber networks. So this suggests that the net effect of this preemption and crowding out is a crowding out effect. In the absence of municipalities, private firms are more willing to install fiber. Okay? And these look like small percentages, but when we place them in context with the fact that there's 2.91% of municipal provision, they're not that small. They're a reasonably large share of total public provision. The final outcome, however, is that it's not enough to compensate for the loss in municipal provision. Right? There's a significant loss in the fraction of markets that have access to fiber. I think I'm about out of time here, so I'll sum up and say, we do have a couple of minutes. OK, if you insist. Yeah, so the last thing I'd like to share with you is the welfare results that stem from this simulation. Okay? And so I'd calculate the effect of this ban on private profits, public profits, and consumer welfare. And what I find is that when you ban municipal provision, there's an increase in private profits, right? They face less competition. At the same time, there's a decrease in public profits because they're unable to provide this service. And there's a decrease in consumer surplus because they're losing access to fiber in these 2.24% of markets. Okay? And so the net effect is that over this 20-year span that I simulate these actions over, there's about a $19 billion loss in total welfare across 30 states. Okay? So for a practice that's still relatively uncommon and on the rise, I think this is a fairly significant effect. Okay? And so the kind of bottom line takeaways here are that a ban on municipal provision across 30 states would decrease total welfare by about $19 billion over 20 years, that municipalities value consumer surplus, but only at a rate of 23 cents on the dollar. So they're not profit maximizers, but they're not maximizing total welfare either. And I find that public provision both crowds out and encourages private investment. It just depends on the market, but the crowding out effect dominates. This means that when we take away public provision, private provision goes up, but it's not enough to compensate for the fact that we lose public provision. Thank you.
So thank you for inviting me to discuss Kyle's paper. I think it's really fantastic paper. In terms of just summarizing kind of what I took away from the paper, In terms of his objectives, he sought to first estimate demand for broadband technology at a very local level. This is something, that I think at least I've done for a single market. He did it more broadly, related to demographics. I think that's really important. And then something that I haven't been bold enough to even try or even think about trying yet, which was to quantify the costs associated with different technologies, and then also private and public entities, which is a whole nother dimension to even thinking about costs. And then one other effort that I think he took on here, which I haven't really seen anybody go after yet, is to really tackle the supply side full on. And he writes down this dynamic model, entry, exit, investment, and includes this public entity in it. So I think there's a lot of really great things that his paper is contributing. In terms of his main findings, one thing that I haven't seen a lot is this relationship between demographics and demand. Kyle collected a lot of really neat data to actually get that relationship and understand it. Then also finding out, what is the motivation behind municipal broadband? What are they trying to optimize? He finds, it's at least mostly it seems like profits, or they're behaving a lot like private firms, but they have essentially some higher costs associated with providing the service. And then he quantifies this crowding out effect. And then actually this counterfactual I think is a nice one, where he's looking at a ban on municipal broadband. Okay, so I will say Kyle's on the job market. You should all hire him. I think he's doing fantastic work, so I'll plug him there. In terms of this particular topic, I think it's the best paper, period, on it, empirical paper on this topic, hands down. I think it's really great. The data collection effort, he's piecing together things from all over the place. A couple were actually news to me. I didn't know they were out there, so I think he does a really great job there. The dynamics on the supply side was really, I think, a frontier push, stuff I haven't seen. And then I think he's contributing to some larger literatures more broadly. So I think Kyle's going to have a great job market. All right, now let me try to be as tough as I can so he can add all these footnotes to the paper, so he can tell people, I've thought about everything that a mean referee might say. All right, so the first thing when I was thinking about the public objective, so Kyle writes this down as basically a combination of consumer surplus and profits going to the municipality. One thing that I don't think Kyle really mentions or brings up is the fact that a lot of times when you hear the story for municipal broadband, it's about economic development and the role that businesses might have and taxation maybe of those businesses that are going to come. It might not just be all residential stuff, and I couldn't really tell from the paper, what was happening with businesses, and if I provide broadband to them, what am I getting in return? And then maybe a dynamic feedback effect onto consumers from that economic development. And the other thing that maybe I was worried about a little more was that during this time period, municipal broadband was subsidized a lot through the Stimulus Act. And so the question is, what were the incentives? Were they really internalizing all the costs associated with the provision? I'm not 100% sure there. And this is just my ignorance, is where this question is coming from. So I really don't know how that financing was done. One just kind of technical question was, there's really two things going into the dynamic supply side, the empirical part of the model, and that he needs to identify. One is the weight that the municipality is putting on consumer surplus, and then the costs of the public entity providing the services. And right now, I don't think there's a rich enough discussion there. I think what it is basically costs have been fixed across these areas, and consumer surplus is varying, and that's providing the identification. And so, I think to me, the one thing was, well, could we have some shifters of, say, costs that you'd have consumer surplus variation and then also cost variation. And, something like density of the population, just how far do I have to run the wire to get it to enough people to make it worth serving? I think you can address that pretty easily with including something like that on the cost side. Okay, This one, in terms of stability of preferences, so you estimate demand using 2010, 2014 data. We know demand is evolving rapidly. You know, over-the-top videos now the big thing was file sharing. Maybe it'll be something cool I don't even know about yet. That'll be driving growth in a few years. You know, these preferences are going to be evolving. So when we think about a simulation going out maybe 20 years, you know, what are preferences going to look like? You know, I think you can make some assumptions on it and simulate it, but I think that might be something you want to do to maybe quantify this more accurately, or at least give some different paths for what this might look like. And one thing, I was looking at the discount factor of 0.9. It seemed maybe a little bit low. I'm guessing this might actually be just simply for convergence and solving the dynamic model, which I sympathize with, but you might want to see if we can crank that up a little bit. I don't know what a reasonable number is, but we might want to play around with that. As far as other counterfactuals, so you've got this fantastic model. So you do one counterfactual, which I think is sensible and reasonable. But when I was reading the paper, you get this result that private firms actually have a lower cost of investment. And so the question is, well then, you know, maybe what we should be doing is subsidizing them to actually do these investments directly, maybe rather than having, you know, kind of this indirect effect of trying to get them to preemptively invest. I don't know if that's the option, but it might be one that I might like to see. And then maybe what those subsidies, or what an optimal subsidy looks like, and compare it to relaxing this ban. These are just all really minor comments. One thing I think in the demand estimation is we're assuming that basically firms are all identical, conditional on the technology. My data point, I would say, with respect to having been a Charter cable customer and now having somebody else suggest maybe that isn't the case. I'm guessing that this is actually because this becomes then a state variable in the dynamic model, which might be intractable. And right now, I don't think you have that is the reason why maybe the demand specification is more parsimonious than I might like it to be if I was only estimating demand. And so I think that's something to maybe lay out, or at least an excuse not to have it there. Okay. And then I think there was one question. These are, the next one's really minor. One thing I would say is, and this goes back to kind of my earlier comment on subsidies and that, is maybe fiber shouldn't be the only focus. You know, DOCSIS, I think about DOCSIS 3.1, and it's rolling out gigabit speeds kind of all over the place. And so the big difference between fiber and kind of DOCSIS 3.1 is bandwidth, right? It's not really speed. How many people really need that, you know, fiber bandwidth to their house? It's not real clear, right? So I think separating the speed versus, you know, gigabytes or bandwidth is maybe an important thing for at least residential service. One other, and this is an assumption I sympathize with, it's one more parameter in the dynamic model, is that the cost of connecting households is zero. I'm not so sure that's actually the case, and I think Google's recent experience kind of demonstrates that, where they're realizing, you know, running fiber to everybody's house, it really isn't costless. You can pass a house pretty cheaply, but actually getting into the house and having to serve the house, it becomes really expensive once you're in somebody's house. And you see some of these guys actually just running Wi-Fi poles in a neighborhood right at the road. And so I think that maybe isn't the best assumption. These are just more minor comments that I'm out of time, so I won't bother to run through. But I think the paper's excellent. Kyle does a wonderful job, and I hope to see future revisions of it. So.
A couple things that I think he raises that are sort of already on the agenda is to address ways that would better identify the parameter on consumer surplus. And I think his suggestion is spot on to think about things that are shifting costs separately by market, population density being a key one. Yeah, and then the second one that I think is, is something that would be nice to address as well is this idea of, demand is estimated statically, but demand preferences do actually shift over time. I haven't had a way to deal with that yet because I don't have a panel of data. The data is only available on the demand side for 2014. So if you have some suggestions for how to deal with that, I'm all ears. Maybe there will be something done in the future. As new sets of data come out in future years, it might be possible to use those to construct a panel. But I don't know that there's going to be a way to do that retroactively. There's no way for me to get access to pricing data from 2010 or 2012. This is data that I collected in 2014. So I'm open to any thoughts on how to deal with that. But yeah, any questions?
All right. Any questions?
Yes.
Kyle, nice, excellent paper. Nice discussion too. Just a few quick questions.
Sure.
So on the demand side, so you're using the CPS data for that mostly?
That's right.
So you're using ACS to get the demographic data, but the American Community Survey?
Yeah,
but
that's right.
Doesn't that also have some of the demand? I believe that also has some of the info in terms of use of internet in the home and stuff like that.
Yeah,
There's a couple years of that, so you could, and there should be another one coming out. So I think pretty soon you could be able to construct a panel.
So that's true that the ACS, there seems to be some overlap in that question between the ACS and the CPS. I know that in future years of it, they've removed this question that that asks, do you use cable, DSL, or fiber?
Okay.
And it's no longer in the survey.
Okay.
2015 is going to be the last year that that's included in the survey.
Okay.
So yeah, again, going forward, I can get that 1 year in there, and I can scrape prices again in 2015. And the ACS data is available in 2010 through 2014, but I have no price or plan characteristic data for those time periods.
Got it. And sorry, just very quick. I think the business development angle. So the discussant mentioned.
Yeah.
I just want to again highlight it. That I think that's a pretty important one when you just do Google News searches and whatnot. That's what the folks in Tennessee talk a lot about.
Yes.
So I think that's something to highlight as a right.
Yeah, I totally agree. And actually, when I first set out to write this paper, I wanted utility to be, profits, consumer surplus, and internalizing this externality of the economic growth. But that turns out to be pretty difficult to do because you also need to incorporate a measure of how fiber investment is going to affect economic growth, which that's a whole separate paper, one which I do plan to write.
Yeah.
But I think you're right. I think that's an important angle, and I should probably devote some discussion to it in the paper.
And then just the last comment, then I'll hand the mic over to this gentleman here. I would try to, when you're presenting, I would play up the FCC angle a bit more.
Okay.
I feel like it's in the news right now.
Yeah.
In my opinion, it's super important.
Okay. Yeah, I'll stress that harder.
And your research speaks directly to it. So.
Great. Thank you.
Really, it's Madura Vijayavarnam from Comcast. Really great paper. I actually read your paper when Nick sent the list.
Thank you.
And I haven't seen. I think, like the gentleman was saying, I haven't seen your. I've been looking for papers looking at the whole crowding out effect. I haven't seen one before, so really great. I just had several questions, but I'll just only ask you one.
Okay.
On the sort of when you use fiber, you sort of I think, and correct me if I'm wrong, please. I think you make the assumption that people would like fiber, and often you said the elasticity that people on higher incomes tend to choose fiber.
Yes.
But on the other point, you said that the demand is inelastic when it comes to speed and also price.
Mm-hmm.
So the way that I look at it, people don't necessarily choose fiber, but they choose the speed that is offered by fiber.
Right, that's true.
So the two seems to contradict. So I was confused, and also because the FCC's data, the 706 data shows, for example, across the country, 90% of the country has access to 25 megabits per second. I think the most recent one, the 2016 706 data said.
I'll have to trust you on that, but that sounds
roughly
reasonable.
About 45% actually subscribe. So my question was, is your demand model in terms of demand for fiber, is that missing something? Because you're assuming that there is this demand, but when the prices when the speeds are looked at, people seem to be choosing for some more sort of the median speeds that are both offered by cable, not necessarily DSL, but definitely upgraded DSL, cable and fiber.
Yeah. So, I wasn't able to spell out, kind of all the details of the demand model here, but I think a key thing that's helping is that not only do I include the price and speed characteristics directly, but I include a fixed effect for each technology, which should be capturing any other characteristics that are unobserved to me that are relevant to that choice of technology.
I want to ask about the counterfactual.
Sure.
So you use 30 states that do not have any restrictions, municipal. Is there a way to actually use a counterfactual of what will be like if we liberate the municipal broadband? Instead of like
if we take the other 20 states and allow them to do it?
I understand that you don't observe entry much in the other 20, but have you thought about how you can address that?
Are you asking about the
So
counterfactual where you take those 20 states and then open it up to municipal?
Right. So instead of thinking what will happen if we ban?
Yeah. Just the converse.
I think it's a bit questionable whether it will happen.
Yeah.
But should we liberate, which is I think a more possible scenario.
Right. So first of all, yeah, I think I can do that. I would need to make the assumption that municipalities in those areas that are banned have the same preferences and the same costs as the places where it's not banned, because I only use data from places where municipalities can enter to get my estimates. But I don't know that that's a terribly strong assumption, right? I'm already assuming that the preferences are the same across the different states in the sample. So yeah, I think that's something I can definitely do. But I want to stress that the point of the counterfactual is less about what happens if we actually repeal this ban, and it's more about what is the effect of municipal provision, right? So it's not necessarily that it's realistic to think that these bans are going to go away, but we can ask ourselves, how much are we losing by the fact that it is in place? What would be the difference in private provision if they weren't there?
All right, great.